Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to the Bert Salazar Retirement Show. My name is Bert Salazar, and I'm going to be the host for this episode today, as I am every single week. This is actually episode 149 of the Bert Salazar Retirement Show, and this is part 3 of how to defuse the 401k time bomb. So we're going to spend a little bit of time together, and I'm going to be talking to you about some things that are going to be very, very important for all of you to consider as you start to take a look at what is happening in the United States, not only with the printing of currency and obviously the spending of money that we don't have. And now not only do we have a $1.9 trillion COVID bill that has just passed the House and the Senate, but also there's another proposal that is going to be coming forward in the next 7 to 10 days, which is going to deal with infrastructure. So that's going to be anywhere between $3 to $5 trillion. Yes, you heard me correctly, $3 to $5 trillion of additional expenses on money that we don't have. So you can understand what that's going to do to inflation. You are also going to understand what that's going to do to the purchasing power of your existing dollars and savings right now. But most important, you need to prepare for all the taxes that are going to be coming down the pike in the next few months in order to offset all of these liabilities. So if you'd recall, I did a couple of weeks ago, I did your 401k is a time bomb in the making, and that was part 1 of that show. And then part 2 I did last week was how to defuse a 401k time bomb. And I talked a little bit about Roth IRAs, Roth 401ks. I briefly mentioned municipal bond funds, and I'll talk a little bit about munis today as well. But I'm also going to be discussing with all of you something that many of you have been misinformed about, and it is one of the greatest tools available for diffusing the tax time bomb and 401k time bomb that is going to be coming down the pike. So we're going to be talking about life insurance. Primarily, we're going to be discussing permanent life insurance and the features and benefits of that product, and the fact that it is the most versatile tool that you could have in your tool shed when it comes to protection, growth, tax planning, tax efficiency, and so forth. So I hope you enjoy the show, and I'm sure you will. So let's talk a little bit about the features and benefits of municipal bond funds. Now, as you all know, whenever you buy a muni bond fund, whether you do purchase individual municipal bonds or you do it through a mutual fund program, the contributions to muni bonds are after-tax contributions. That means that you have already paid taxes on that money. Now, as long as you don't touch those assets, the money is growing on a tax-free basis, so all those accumulated funds will grow on a tax-free basis. There's also a tax-free distribution of accumulated funds in your residential state. Now, what do I mean by that? Well, if you live in Florida like I do, and you purchase a muni bond fund in the state of Florida, then obviously any distribution will be federal income tax-free and state income tax-free as well, because you're actually purchasing, or you purchased that municipal bond in the state in which you reside, and you're helping or you're assisting the state or the municipality by purchasing those bonds. Now, the state of Florida doesn't have any state income tax, but if you live in a state that has state income tax, then as long as you purchase those municipal bonds in that particular state that you reside in, then not only are your bonds going to be free from federal income tax, but they're also going to be free from state tax. So you got to be careful about that. Also, because you're investing in a municipal bond fund, you have access to your accumulated funds prior to age 59 and a half. So the IRS is not going to place any type of regulations or any type of handcuffs on your access to municipal bond funds at any point in time. Now, there's no required minimum distribution, no RMD at age 72. So if you have a portfolio of municipal bond funds and you are now age 75, you don't have to worry about it, because there is no taxes, there's no required minimum distribution, there are no tax penalties. You are free to do anything that you want with those funds. You don't even have to take the money out, and you can actually die with those funds in your possession, and they will go to your beneficiaries on a tax-free basis as well. Now, one of the biggest challenges is that you need to pay attention to, and you have to be careful as you start putting money into municipal bond funds, is that they do have and they do produce and they do have a negative impact on your provisional income calculation. As you know, and we've talked about provisional income calculation about 50 times in this show that we've been doing now on a weekly basis for the past 3+ years. But, provisional income calculation is what determines what percentage of your Social Security benefits are going to be taxed in retirement. So any distribution that you have out of a municipal bond fund has to be added on to the overall calculation in order to determine if your Social Security benefits are going to be taxed or not. Now, that's important. So if you have too much money or you're taking too much money out of a muni bond fund on a given year, then your Social Security benefits may very well be taxed. In addition to that, the provisional income calculation in which you're putting these muni bond funds in can also have a negative impact on the annual premium that you pay on Medicare. So municipal bonds are good, are excellent tool from a tax-free and protecting yourself from the time bomb or the tax time bomb that we're all going to be facing in the very near future. But be careful, because they do have a negative impact on your provisional income calculation. And then lastly, on municipal bonds, is that they're not creditor protected. So if you get sued and you have $100,000 in muni bonds, if you're found guilty and you don't have any liability protection to cover you, then you might as well kiss those municipal bonds goodbye. So, but overall, between Roth IRAs, Roth 401k, and municipal bonds, you start to create a very good plan in which you can offset many of the potential tax liabilities that are going to be impacting not only you and your retirement assets, but also your family in the very near future. So let me shift gears once again, and I want to talk a little bit about the features and benefits of 7702 plans. A 7702 plan is nothing more and nothing less than a life insurance contract. And you would say, well, Bert, why would you want to talk about, life insurance when it comes to diffusing that major time bomb that is going to be hitting us in the next few months and or the very near future, to say the least. And the reason why I want to touch upon this is that most Americans have really very little understanding of how life insurance works. You can buy term insurance, and that's pretty much buying death insurance. You pay a premium, you pay a very low premium. You can buy a 10-year, 15-year, 20-year, 30-year level term insurance policy, and if you die within that time, the life insurance company is going to send the proceeds of that death benefit to your beneficiaries on a federal income tax-free basis. So, every one of my clients, myself personally, I own term insurance because it's a good product to have, but you're not owning it, you're actually renting it and or leasing it, because at the end of the period, if you haven't died, then you have to buy that term insurance coverage again if you need it. And obviously now you're going to be 15, 20, or 30 years older. Your health may not be as good as it was before, but most important, the premium is going to be going through the roof at that point in time. So now comes permanent life insurance, and you can buy permanent life insurance in a number of different ways. Now, today I'm going to be concentrating on life insurance from a supplemental retirement standpoint. So what we're going to try to do today in this podcast is to share with you how to buy life insurance in order to maximize the internal rate of return and to supplement your retirement income as much as possible. So we're not really buying it for death benefit purposes, although there will be a death benefit purpose. So when it comes to permanent life insurance, you can buy it just like going to Baskin Robbins. There are many different flavors. You can buy whole life. You can buy universal life. You can buy variable universal life in which you're investing in the market. I don't recommend it, but a number of my clients have it. I even sold it at one point in time in the past. You can buy fixed index FIA, so you can buy life insurance that come with a chassis of fixed index products. So you can buy it in many different ways, and or you can do a combination of both. Some of my clients have fixed index and also whole life as part of their life insurance program, and it works very, very well because the features and benefits are different from one to the other. So, with that being said, and without getting so deep into the weeds, in order to figure out which one is the best product for you, and obviously for every one of you is going to be different. It depends on what you're attempting to do, but let's go into the features of a 7702 plan and or permanent life insurance for today's topic. Now, is based or is funded with after-tax contributions. Now, you do have the ability to actually purchase life insurance inside a qualified plan. So if you have a pension, or if you have a deferred compensation program, or even a 401k, and the plan document dictates that you can buy life insurance inside of those plans, then the premium that you put in to purchase it would be a pre-tax contribution premium. But for most of the clients that I deal with, especially because of the fact that they're trying to maximize their tax-free bucket, they're actually buying these life insurance contracts with after-tax premium. Now, as I said earlier, today I want to focus on using life insurance as a supplemental retirement plan. By the way, there are 30 different options that you can use life insurance for. So it's a very, very versatile program for all of you, depending on what your goals and objectives are. But for today's podcast, we're going to use it as a supplemental retirement plan. And what I mean by that is that we're going to try to put as much money as we possibly can based on what you feel you want to fund these contracts to the level of. And we're going to use the least amount of death benefit in order to allow for the funding of the contract. So instead of buying the most amount of a death benefit for the least amount of premium, we're going to purchase the least amount of death benefit for the most amount of premium. And what does that do? Well, that allows for the majority of the funding to go toward the buildup of the internal cash values of these contracts that are going to emulate some of the best products and services or retirement products and services that you can purchase in the marketplace. So after you put the money in on an after-tax basis, your funds are also growing on a tax-free basis as well. Now, you also have tax-free distributions of the accumulated funds inside of these contracts. And when you get to retirement and you start taking money out of these life insurance contracts that are earmarked as supplemental retirement plans, then you're using a FIFO distribution for accounting purposes, meaning first in and first out. So you're going to start to pull the bases in the contract, meaning all those contributions that you made for the last 10, 15, 20, or 30 years, you're going to start pulling that money out first, because since you had already paid taxes on that money, you're getting your principal back on a tax-free basis because you have already paid taxes on that. Now, once you reach the area where now you're going to start to invade the growth in that contract, and usually the growth is going to be much, much higher than the contributions that you ever made, now you have a decision to make. You can either start taking that growth and pay taxes at whatever level you find yourself in at that point in time, or you can borrow that growth and you can take it out as a loan against the collateral of your life insurance contract. And when you take it as a loan, then obviously the distribution is going to be tax-free, because loans are not a taxable event under the IRS code. Now, obviously, you're going to have to pay a fee for the distribution. We use insurance companies where the loan that they give you can be offset with the interest that they're going to pay you on the amount of the collateral assignment. So there are many different ways in which to break even. But I'd rather pay even if I didn't break even, I'd rather pay a 1% loan per year than a 30% tax to the IRS. Now, the death benefit on these contracts, because although we're purchasing the least amount of death benefit possible, there is a death benefit. The death benefits are federal income tax free. So when you die, your family will receive the death benefit plus all of the accumulated funds inside of that contract on a tax-free basis. And by the same token, there's a tax-free transfer of all the accumulated funds at death, so your family will receive the whole thing tax-free. Now, and that's incredible, because it's a tremendous tool in order to avoid having the IRS come in and take it all from you. Another big issue with these contracts is you have total access to your funds prior to age 59 and a half. And that's a tremendous feature, because when you're investing in traditional 401ks, IRAs, 403bs, or other type of pension plans, there's a 59 and a half rule. So if you pull money out of those plans prior to age 59 and a half, not only are you going to have to pay taxes on the distribution, you're also going to have to pay penalties. And when it goes to your Roth IRAs and your Roth 401ks, if you pull money out, but you want to then invade some of the earnings, then you have the 59 and a half rule, and you also have the 5-year rule for Roth accounts. So there are certain booby traps that the IRS is setting up for you. When it comes to 7702 plans and or life insurance contracts, there's no fees and there's no penalties for having access to your money prior to age 59 and a half. In addition to that, there's no required minimum distribution. So I don't care if your retirement minimum distribution was 70 and a half under the old rules or age 72 now. you can have a lot of money in these plans, just like you would in a traditional Roth IRA and in municipal bonds, and the money can continue to grow tax-free past your required minimum distribution age, and the government is not going to force you to take money out and or will not penalize you from a tax perspective either. Now, when it comes to credit protection in Florida, 7702 plans are creditor protected. Many other states have different levels of protection, so depending on which state you live, you may want to check your rules and your law there. But it does offer credit protection, at least in Florida. And also another big feature is that it allows you to fund these contracts above and beyond the maximum contribution that the IRS will allow for many of the other plans that we have talked about, whether they happen to be qualified or non-qualified plans like Roth and Roth 401ks and traditional 401ks, IRAs, 403bs, and so forth. So those are great features that you would have inside of the 7702 plans as well. Another major feature, and this is one that I truly love out of 7702 plans, is that this type of contract is self-completed in case of death or disability. So what if you're 45 years old and you're putting money into your 401k? And you're putting money into the 401k because you want to make certain by the time that you retire at age 65 that both you and your spouse and your children will be fine. But what if you're 45 years of age and you die at age 47? Well, you haven't had enough time to accumulate funds into those accounts. But with the 7702 plan, because you do have that death benefit feature that you purchased when you originally agreed to obtain this contract, then that's going to be self-completed, because now the death benefit, which is going to be much greater than the amount of cash values that you have inside the plan, will be paid out to your surviving spouse and or beneficiaries of your choice. So it's self-completed in the case of death. It's also self-completed in the case of disability. So what if that car accident didn't kill you, but it left you totally disabled? If you have the right amount of riders inside of these contracts, now these contracts can actually continue to pay themselves, just like if you were funding them to the level that you intended to. And now that contract would be self-funded until age 65 when you retire, if that's your choice. And then you can start taking distributions just like you would have done had you funded that contract personally, because you did not sustain a disabling injury at age 45 or age 47. So those features and benefits you don't have in your traditional 401ks, because if you can no longer work, guess what? You don't have any earned income, and if you don't have any earned income, you cannot make contributions to a qualified plan, whether it happens to be on the traditional side or on the Roth side. So when you really start looking and break down all the features and benefits of a 7702 plans, I think I would argue that most of you are going to start to look at these from a different perspective altogether. There's another major feature of 7702 plans that has actually been added, I would argue, in the last maybe 7 to 10 years. Not all companies have done it, but many of the carriers that I deal with have done this. And these are long-term care benefit riders, whereby if you become disabled because you have a long-term care illness, or you need to either have home health care or an activity, or you have to go into a facility for long-term care purposes or a nursing home, this plan is also self-completing, because there are riders that are built inside of these contracts that would allow for a portion of that death benefit to be paid out to mitigate all of the additional expenses you're going to have from a long-term care liability. So you're actually invading the principle of your death benefit without having to die. As you all know, if you happen to be a 65-year-old married couple today, there's a 70% probability that one of you is going to have a long-term care need at some point in time in the future prior to death. And that means that it's going to have a tremendous cost that is going to have to be paid from somewhere. Well, a well-designed and well-structured 7702 plan will allow you to offset those liabilities by providing these long-term care riders. Now, for those of you that may not know this, there are competitive rates of returns in 7702 plans, and you can do so through indexes, separate accounts. You can do it through guarantees. There are many different ways that you can fund these contracts and for the growth to move forward into the future. Another major feature is that there are no Social Security tax triggers. So that means that that provisional income calculation that I just talked about a few minutes ago regarding your qualified plans and also your municipal bonds is not applicable here to 7702 plan. So if you take money out of a 7702 plan and you take a lot of it out, it's not going to have a negative impact on your Social Security benefits and is not going to have a negative impact on your Medicare premium as well. So that's a tremendous feature. And like I said, there are 30 different contractual uses that you can use these contracts for. Now, the way that I try to work with all my clients, again, once I do my due diligence and we do a proper fact finder and we identify what it is that our clients want to do. We have clients that they buy multiple of these contracts. They want to use one as a permanent guaranteed death benefit only. Sometimes they purchase another one as a supplemental retirement, which is the one that we're discussing today, where you're going to buy the least amount of death benefit and the most amount of premium. And then last but not least, there are some that are a combination of both. So depending on what your goals and objectives and the amount of funding that you have set aside to do on an ongoing basis, then we, between us, the advisors and the retirement strategist and the clients will determine how much funding we're going to do. So traditionally speaking, the way that these plans work is that the insurance company is going to determine the minimum premium based on the amount of death benefit that you decide to purchase. On the other side of the spectrum, the Internal Revenue and the Internal Revenue Code is going to determine the maximum amount of funding and or contributions that you can make to these contracts. And we can dial those up and we can dial those down. And the reason why the IRS has those guidelines in place is that they understand that once Americans start putting money into these contracts, and they've been doing so for decades, the IRS is never going to get a dime out of it, because not only is the growth going to be taken out via loans and never pay taxes to the IRS, but the death benefit is going to be totally tax-free as well. So the IRS is going to let you play, but they're going to tell you how far you can play and for how much. And then now that the insurance company determines the minimum funding and the IRS determines the maximum funding, then we, in our firm, with our clients, we are the ones that determine the optimum funding, which is different than the minimum or the maximum funding. So depending on your individual circumstances, we are going to determine what would be the optimum funding based on your goals and your objectives and your needs and so forth, and your many times your desires from that purpose. So I'm hoping that you have enjoyed this part 3 exercise on how to diffuse that tax time bomb and the 401k time bomb that is going to be hitting all of us at some point in time in the very, very near future. Next week, I'm going to do a podcast, and we're going to be talking a little bit about, cryptocurrencies, and we're going to be talking about Bitcoins and the opportunities and the challenges, because I'm getting quite a few calls along those lines. So I'm excited to also start digging into that a little bit more next week from a business perspective. So for those of you that want to reach out to me to talk about some of these topics that we discussed today, and or any other topic that may be keeping you awake at night from a financial standpoint, please feel free to reach out to me. You can call me at area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And always remember that my goal for you and for your family is to kind of help you change the way that you see things, because when you start to change the way that you see things, the things that you see change. So once again, thank you very much for giving me a few minutes of your time today, and I'll talk to you soon. Take care and have a great week. Bye-bye.